Good afternoon, everybody. My name is Alex Tilson. I'm Managing Director for International Business Development at Primonial REIM. I'm based in our London office, and I'm delighted to be here today to present this webinar. This is actually our last webinar of 2022, and we've got a range of interesting topics to address today. So hopefully you can all see the slides on the screen. But firstly, we're going to be starting off with a discussion about real estate in the current macroeconomic environment, and how the asset class can continue to show resilience during these challenging times. That's going to be followed by a deeper dive into the topic of inflation, and that's certainly a factor which is on the minds of many people in the industry today. So really, what's next for the topic of inflation and real estate? After that, we're going to address ESG, environmental, social, and governance issues. This is a subject which continues to be highly relevant, and in fact, we're going to be discussing, how really strong sustainability for assets has become the new norm in our industry. And then finally, we're going to talk about the best values which are required not just to survive but to thrive during times like these, which a little more difficult than perhaps we've been used to over the last several years. So expecting this webinar to take around 45 to 50 minutes, and then there's also time to address questions as well. Please do use the Q&A function on Teams to be able to ask questions, and we'll try and address as many of those as possible. So I'd like to start by welcoming our speakers today. In particular, we have a guest speaker, Corinne Dasset from MSCI, and Corinne is Head of Real Estate Client Consultants Division for France, Belgium, and Switzerland, and she'll be providing some insights across all of these topics that we're talking about today. And then three of my colleagues from Primonial REIM as well. Firstly, we're joined by Jürgen Fenk. Jürgen is our Chief Executive Officer, has around 3 decades or more of experience in international real estate and banking, so hugely experienced. And Jürgen is also a global governing trustee of the Urban Land Institute, and previously served as the European chairman up until 2020. We've also got Daniel Weil. Daniel is Head of Research, Strategy and Sustainability, so highly qualified to talk about the topics that we're going to be discussing today. And Daniel has been with our firm for over a decade now. And last but certainly not least, Henri Aurélien Natter. Henri is our Head of Research, and one of Henri's key responsibilities is to produce the publications and the research that we provide to our clients and stakeholders about the economic and capital markets trends across Europe. And we'll be talking again a little bit about that during the session. But first of all, I'd like to hand over to Jürgen to provide a short overview of Primonial REIM and our business in Europe. Thank you, Jürgen.
Thank you, Alex. Just really a very quick overview for those who may not know Primonial REIM. So we are a pan-European real estate platform active through in 6 countries through local offices. So we are present in France, Germany, Italy, Luxembourg, the UK, and Singapore. We are providing investment and asset management services to institutional and retail clients. Our portfolio is pan-European. We're in 11 countries. And what is important is that we also have our own property management companies in times where we need to work on the assets more than ever, and where we have to implement our ESG measures. It's always good to have your own property management firms who give you the priority of service. If you go to the next slide, we are about 33 billion euro large in terms of assets under management. What I said before is that the beauty of our business is that we have a diversified equity source between retail investors and institutional investors. We can imagine, and during these times, it's a very valuable thing to have. We are about 400 people, including our property management companies, and we manage across all the sectors we're active, 61 funds. We are a very important player in offices and in healthcare, and especially healthcare is an asset class where we are certainly a leading, if not the leading investor in Europe. With that, I would hand over back to Alex to go into the topics of today's discussion. Thank you.
Thank you, Jürgen. So to start off on our first topic today, which is real estate and its resilience in the challenging context from a macroeconomic perspective, again, we're very pleased to welcome Corinne Dassé from MSCI to start off on this topic. So Corinne, perhaps I'd like to hand over to you, and perhaps you can provide an overview of how your organization views the asset class and the performance and trends.
Hi, Alex, and hi, everyone. Can you move to the next slide, please? Yes, perfect. So thanks for thanks to Primonial for maybe not just the previous. Sorry, if we can do one. Yes, perfect. So good afternoon, everyone, and thanks to Primonial for inviting me to this webinar. So today I'm planning to share with you the latest MSCI trends on transaction and performance, to understand how the real estate market is starting to react to this inflationary and rate increase context. Maybe before analyzing some trends, a quick reminder on what MSCI indexes are. Actually, we are collecting asset level and fund level information directly from asset owners, asset managers, listed real estate companies, covering valuations, costs, income, capex, transactions, etc. And our indexes cover more than $2 trillion of assets globally across all sectors and 1 trillion euros in Europe. Next slide. Today, because we need to analyze quarterly trends, I will use the Pan-European Property Fund Index performance, which is a smaller sample that only focus on pan-European open-ended funds. This index actually is covering around 67 billion euros of capital values, and has the interest to show both a fund level return and an asset level return. I have mentioned on the slide the sector composition, and you'll see that the weight of industrial is quite important due to the nature of quarterly value funds included. So what's happening? On the right chart, you can notice a historical decline of the quarterly fund the net fund return at minus 1.4% in Q3, and the impact on the property level return is minus 2.4%. Is slightly the gap is slightly lower when you analyze balanced funds, so when you exclude industrial funds. So when we try to understand this huge sharp, it's actually the capital growth that explained the drop, while the income return has remained stable. And in terms of country, it's the United Kingdom that has been the most severely hit. Next slide. So let's drill into this index a bit more and analyze the trends by sectors. And as you can easily notice on the left chart, all sectors have been impacted by the crisis in Q3 with a negative capital growth. So obviously it's interesting to wonder what has impacted the most the capital growth. Is it coming from rents, so the rental market? Is it coming from yield increase? And actually the market rental value growth has remained positive in Q3, and that's the yield increase that has driven the capital values down, particularly in this context of bond rate increase and credit rates increase environment. However, you'll notice there are slight differences between the sectors. So hotel actually managed to keep a positive quarterly total return. The retail total return was flat in Q3. That's the industrial sector that was really very trendy over the past quarter, that has been the most severely hit in September. With a negative capital growth of minus 3.8% in one quarter. That brings the total return on industrial to minus 2.9% in Q3. Offices are the second sector that is the most impacted in Q3. And if we actually drill down on offices and look at the right chart by country, United Kingdom appears as the country with the lowest total return, but all countries recorded a negative total return, and France actually is the second market being impacted. So according to the latest risk analysis on the European credit spread that our MSCI research team has done, if we look at the sharp global recession scenario, which is the kind of worst case scenario, European real estate value could drop by minus 6.3% in the coming months. Next slide. So, well, we mentioned as the main explanation of this drop is the yield increase. So obviously it's interesting to understand what's linked to yield and therefore the transaction market. And here I'm going to present you the analysis prepared by Tom Leahy and the MSCI research team. So you can easily notice that the real estate investment situation has deteriorated over the course of the year. But as often in real estate, there is a lag between world events and the direct property market. As a consequence, the slowdown has becoming increasingly evident in the third quarter, as you can notice on the chart. The MSCI Real Estate Transaction Database shows that in Q3, the year-on-year transaction volume was down 37% in comparison with the same period a year ago, and the year-to-date volume fell behind 2021 numbers for the first time, having been well away at the end of July. What's more, we noticed also fewer properties traded in September than for any month since August 2020. This decrease has been observed on all sectors except senior housing and care, that is quite small. And if we maybe check offices, the activity continued to fall. Transaction volume was down 44% year on year for the third quarter and 5% for the year so far. So despite the, on the top of the context, the economic context, and the office sector continues to suffer from the several structural issues, notably the move to hybrid working patterns and the threat of obsolescence. And in particular, on this last point, government legislation and occupier preferences are dictated a shift toward energy efficient buildings, threatening the value of buildings that do not or cannot meet this criteria. Next slide. So this drop in transaction is also seen in terms of number of participants to the market, and the number of buyers and sellers actively involved in deal making in the third quarter fell to a 9-year low. So it's evident from the data that sellers especially have become less willing to test the market, while the outlook for the economy and interest rates remain so unsettled. And at the same time, buyers with equity to deploy may be waiting for further falls in valuations and transactions prices before re-entering the market in search of opportunity. Next slide. So if we actually use the RCA CPPI data, which is based on transaction prices, we have tried to quantify the price expectations gap in Europe in the two largest markets, which are London and Paris offices. And it shows that the gap buyers and sellers would have to bridge in order to bring the market towards long-run average transaction activity is more than 10%. So when on this chart, and when the data number is negative, this indicates that the market is a period of low liquidity and price falls are more likely. But that does not forecast that prices will fall, and also that liquidity can remain at low level without prices falling, as it has been noticed during the COVID-19 crisis. However, we are in a different situation than the pandemic because of the credit rate increase. And we have the possibility that assets will be pushed onto the market because of refinancing programs or the redemption issues facing some fund managers.
Great. Well, thank you, Corinne, for that presentation. And one quick question from my side, actually, I noticed, particularly being based in the UK, when you looked at the different countries across Europe and the performance of the office sector in particular, the UK had performed far worse, I think, than the countries in continental Europe. Is that a timing issue that we're recognizing potential losses earlier, or do you think the UK market as a whole is just performing, perhaps underperforming other markets?
Actually, there is clearly in the different crises we have shown over the past, there is a quickest reaction of the UK market in general to the crisis. But then there are obviously other reasons now impacting the different markets, particularly due to inflation. France is a bit less impacted at this stage than other markets. And the UK is clearly strongly impacted. And the industrial market in particular, we mentioned offices, but industrial market, which was recording more than 30% of return, is now down because the yields were also very low. So it's also the readjustments between yields and the bond rates that also explain all those readjustments.
And the central bank in the UK was quicker in adjusting interest rates than the ECB was. I think that also explains that phenomenon.
Mm-hmm. Yeah. Super. Well, again, thank you, Corinne. And Daniel, from the Primonial REIM perspective, what's your view in terms of the strengths of real estate as we come through this turbulent economic period?
Well, first of all, Corinne's MSCI's data presented by Corinne are actually fascinating because they are the first data which is really relevant to transactions that were originated after the war in Ukraine. Because 2022 is a sort of mixed year where you've got the transactions that were originated in the environment of a post-COVID recovery. Okay, that's the beginning of the year, and basically these transactions have been made in the first semester under the conditions for a lot of them that were relevant before the invasion of Ukraine by Russia. Then now we're seeing in these data the decrease in investment. So I think it's that of course today we're seeing a lot of transactions that are postponed rather than discounted. That's what we were saying when Corinne stated that it's not because you have a drop in liquidity in the market that the prices are going to adjust mechanically immediately after that, because it depends on the anticipations of the players. I mean, if you believe that the inflation is an inflation bump, that it's temporary and we're going to pass it, just like the COVID pandemic, then it's not the same result on pricing than if you believe that we're going to shift to an inflationary environment. I would say today we're seeing a lot more transactions that are postponed rather than discounted, even though we have a bit of discount, of course. And second thing that strikes me in Corinne's presentation is the extent to which asset classes within real estate perform very differently. I would say not with the same market timing. We see that industrial, which includes logistics, has repriced before all the asset classes. We see that hospitality and retail have actually been quite stable, probably because they have been already violently repriced during the COVID pandemic. We see that that residential is holding up, that the office market, perhaps because it was expensive, is beginning to see its repricing. But that's a very strong point in favor of diversifying investments, meaning that all real estate asset classes are not going to underperform or overperform at the same time. So that's why we at Primonial REIM, we've always favored an allocation approach with different sub-asset classes in real estate, because clearly I wouldn't go that far to say that they are a hedge for each other, but they are going to have a sort of diverse behavior in crisis. So it's important to move on lots of asset class. And the last thing I really notice is that we know we're near what happened at the end of 2008 at the Great Financial Crisis. When there was a Great Financial Crisis, we all remember that there was some kind of panic and covenants were being activated by banks with forced sellings. And I think the danger in real estate is always about liquidity, is always about forced sellings. We're not seeing that in the current environment because the ECB has been planning for these interest rates and announcing them several months in advance. So my view is that the market is currently adjusting to a new environment, but without the total uncertainty and the flavor of panic that we had after the Great Financial Crisis. So that's rather a good point. The repricing we see is mainly driven by refinancing of assets by the lending side. Clearly, the lending borrowing conditions have completely shifted. We're in negative leverage effect in most of the asset classes, and that's a non-starter for a lot of institutional investors. Okay, so that's where the repricing is coming from. In some cases, in some asset class, but we're not seeing any massive drop in liquidity like we saw after 2008. Therefore, our view is that there's kind of we have to think in two different time frames. The first one is weathering the inflation bump. Trying to model through the inflation bump, which is basically cost-driven inflation because of the Ukraine crisis, which is of course trickling down to most asset prices. But there's a reasonable case to be made that we're already on the end of that bump, or we're going near, as the Federal Reserve seem to believe also. And the second time frame we have to keep in mind is how is real estate going to perform in the next environment post-crisis, with, of course, probably we're going to get out of negative interest rates, which were the great driver of capital gains in the last year. So how are we going to adjust to that new normal?
Great. Thank you, Daniel. And I mean, when we talk about the banks raising interest rates, I mean, how far do you think they can realistically go? Will it continue, or are we at that point now where,
I think Alex, that there's a big difference between our current situation and the 70s, for example. In the 70s, when Paul Volcker, the head of the Federal Reserve at the time, had this very, very strong policy of raising interest rates by very large to a very large extent. The big difference is that states, governments, have 100% of their GDP equivalent in debt. So you can't raise interest rates too much in that financial context, because the interest of government debt is going to cost you too much. You couldn't sustain it. So really, I believe that there's the financial situation, which is to me a limit to the rise in interest rates, and of course there's the recession. I would say the base case is a sort of mild recession in Europe, and of course one of the tools that the central banks have to manage a recession is actually lowering interest rates. So that could happen, but of course we need to be sure that we are on the end of the inflation bump before. But that's something we could see in 2023 possibly.
Good. Well, thank you. That's very insightful. Henri, I'd just like to move on to you in terms of how we at Primonial REIM produce content to help our clients and our stakeholders to understand the markets. Perhaps you could just give us a little bit of insight into the process there.
Yeah, hi Alex. First, I wanted to say that I'm very happy to be there today and to give me the opportunity to share with you our view on real estate perspective. So, if we have a look on this slide, what I wanted to say, it's, we have this high inflation in the Eurozone, and because of this high inflation of the Eurozone, the ECB's choice was to raise its policy rates. This is the reason why the 10-year government bonds yield increased in 2022 and should continue to increase in 2023. The good news, I will say, can come from the US, because as you may know, the fact that maybe the peak of inflation can be behind us, it's what the Fed say. And the Fed also tell us that if the peak is behind us, the peak, of course, of the inflation, this means that maybe they will not need to have other big bonds increase for next year. So we can support that if we are going to be in the same situation in Europe, we can guess that maybe we'll not have again a new increase of bonds, or maybe in a lower way. So if I jump of what Karine said a little while ago, what we have analyzed is the fact that there is a link between capital growth and the rapid increase in central bond policy rates. This is the reason why we saw the repositioning of yields and return over the third quarter of 2022. So during the last decade, capital growth drove performance, but we see now that income will drive it. So on this slide here, you have a forecast for the next 5 years. So according to our estimates, some real estate yields could see decompressions between now and the end of 2024, counterbalancing the rising yields on government bonds. It's just what I explained you just before. The consequences of this situation is a reduction of the capital growth. And if the capital growth is not going to be very strong for the next 5 years, we expect that income returns will ensure a big part of the overall performance. So now if we go on the next slide, here I think I wanted to share this with you because I think it's very interesting, and it means that we are not in the same market that we used to be 5 years before. So at Primonial REIM Research and Strategy, we use statistical models to apply the latest official macroeconomics forecast to all real estate asset classes. And what we saw is the fact that between 2023 to 2027, we expect that overall market performance will be driven by, I will say, what we call alternative asset classes like logistic, healthcare, real estate, and residential. But what is important to keep in mind is the fact that market timing is the key to have a good performance over the next 5 years. Hotels also, if you have a look on this slide, are also likely to see a positive trend. And this is, I would say, the reason is the fact that the recovery in leisure tourism is quite good. But we still think that the sector is going to see mixed performance between hotels categories. So regarding return now, as you may know, after a sharp correction during the pandemic and an automatic rebound for this asset class, we predict a period of calm in 2023 and maybe 2024. Now for offices, we think that these assets, and especially offices that are well located, meet tenants' new requirements and respect ESG standards, these kind of offices are likely to enjoy better perspectives than other type of office. And as you can understand, to assure the best performance, the key is to diversify the allocation and the market timing of investment. This is, I will say, what I wanted to say today, and maybe we can.
No, that's great. Thank you, Henri, and certainly on your last point you made there about offices and those ones which are best set for sustainable investment and with strong ESG credentials. We're going to be touching on that again in a short while. But before we get to that, we wanted to do a little bit of a deeper dive into the topic of inflation and really what's coming next. I mean, it's such a hot subject at the moment, not just within our industry, but we see it at home with the cost of our energy bills going up when we go to the supermarket and the things on the shelves are more expensive than they were last week. And I think, in the past, we've always felt that real estate has been favored by investors because it has a certain level of inflation hedging qualities. But we've had an environment now over the last year or so where we've seen inflation rates rise to a level which I certainly haven't seen in my lifetime, and probably most of the people here today won't have experienced before. And the banks have responded by raising interest rates as well, which we've sort of touched on a little bit during the last session. So really, we wanted to discuss the topic of how real estate has performed so far, and what's next for the coming year in the space. Will it continue to perform in this kind of environment? So Corinne, I'd like to come back to you perhaps to address this topic first of all, and I'm just going to pop this next slide up on the screen.
Yes, thanks. And actually, you're quite right when you mentioned that real estate was seen as a hedge against inflation by investors. And actually, in the recent barometer on French investments we have run on the French market, this was pointed as the main factor for investors to invest in real estate, according to them, particularly due to the fact that inflation is included in rent indexation rates. However, actually, when we analyze the past results on the portfolio's net operating income growth versus inflation, as you can see on the chart, consumer price inflation outpaced net operating income growth in most countries in 2021, which means that most countries experienced negative real NOI growth. And this also applies on a longer history.
So Corinne, the countries in blue with the dots, they're the ones where NOI has outpaced inflation, and the kind of lighter greeny color, that's where inflation is, where you've seen a real kind of decline.
Yeah. So the real NOI growth was actually negative, and actually the idea behind that is that NOI is not just NOI growth is not just indexation. You need to take into consideration the vacancy rate on the market, the rent incentives, the renegotiations, potentially client bankruptcies that could also impact the net income. You may also have a balance between supply and demand by location or sector. For example, we have seen this between Paris and Paris CBD and the outside of the Paris city, or between sectors. So it's not just the indexation going through straight into the NOI growth, and that's what would need to be considered in the coming year.
Great, thank you. Daniel, from the Primonial REIM perspective, how are you sort of seeing the inflationary environment for the coming year, and how will real estate look to perform?
From an academic point of view, we tend to distinguish, inflation driven by demand, which is the overheating of the economy, wages going up, and growth being very, very strong. That's what was a bit of what we were seeing at the end of 2021, with the value change disrupted, and actually an inflation which was a recovery inflation, and then there's inflation driven by costs, driven by energy and commodities going up. And that's a very different kind of inflation, of course. And I think we're seeing a sort of mixture of both, maybe a bit more cost driven in Europe, a bit more demand driven in the US, but that would be debatable. What's important is what Corinne said. I wouldn't say that inflation is a hedge, that real estate is a hedge against inflation, but rather that indexation is a temporary sort of moderator of asset values when they are hit by an increase in cap rates, because of course the indexation of rents results in higher rents, but I mean the tenants have to be able to be solvent to pay them. They have soaring energy costs. A lot of them have human resources issues. So what we need to assess is what kind of tenants can pass on inflation to their clients by raising their prices and therefore protecting their margin and allowing for an increase in rents, and which tenants are not able, because it's too competitive for them, to pass on the inflation to their clients, and therefore the room for increasing rents, what we call the effort rate, the rate to which it's an effort for tenants to pay their rent, is restricted. So I would say it's quite different from tenant to tenant. But what's true, and we need to keep that in mind from an asset allocation point of view, is that there's nothing better than real estate to hedge inflation. Okay, at the end of the day, you need to have real estate in a portfolio if you want to hedge the inflation risk. So it's not an insurance, it's not a guarantee, but from an asset allocation point of view, it's you can't go around it, because of course that's why I believe that there's not going to be a total substitution of bonds to real estate in institutional portfolios in the future, because these features of real estate are going to remain indispensable, are going to remain necessary in order to hedge or to moderate the inflation risk into institutional portfolios anyway.
Great, thank you, Daniel. And Jürgen, I saw you sort of nodding as well there.
Well, yeah, I nod because if we don't believe that real estate has some sort of inflation protection, I think we are not doing the right job. So I think from an operational perspective, based on what has been said, it's good to be a pan-European platform, because we have seen that markets are different and react differently inside of Europe, and the inflation is actually different, and also the movements of inflation are sometimes quicker and sometimes slower. So having the ability to offer to our clients to be active in different markets and different asset classes, I think is a good place to be. Now, what Daniel said is that, you know, it depends also really on tenants, but you have different asset classes where it's easier to move the inflation to your tenants than others. I would say residential is probably more challenging because of the political impact and the political protection of consumers, where hospitality on the other side is probably the easiest one, because it's automatically driven in the fact that it's an operational business, and if you are a hotel guest and you pay each time you go a higher price, it is also already the answer to an inflation protection. So we are clearly working a lot, and that's what I said at the beginning of this webinar. Asset management is key, because this is what we are talking about, is asset management. It's really working with your clients, with your tenants, to find the best possible solution for all parties. You know, applicable indexations is one thing legally, but putting them into place by having a fair solution for your tenants is not easy, but it's something that we focus a lot.
Thank you. That's fascinating, and I'm sure we're going to be hearing a lot more about this topic as well, as we come into the new year. I'm conscious of time, so I wanted to move on to the next topic of this webinar, which is ESG, and we've entitled "Why Green is the New Black," especially in real estate. In other words, how has and why has sustainability really become the new norm in real estate? Corinne, I think you're going to start us off on this topic. And also we did have a question come in as well during the session, which asked about whether there's any tool produced by MSCI in relation to specifically ESG monitoring and implementation. So if you're able to also perhaps address that topic during your discussion, that would be great.
Sure. Thanks. And maybe you can show the next one slide, that can illustrate what I'm going to tell. Is actually that this ESG monitoring is starting to be taken seriously into consideration by investors, and you can already notice it in the price paid by investors. So here it's London and Paris offices. And you see that there is a premium that has emerged for buildings that have sustainability ratings, so the BREEAM, LEED, HQE. In London, you see that the gap appeared from early 2019 onward, and it's now standing at more than 25%. And in Paris, the gap emerged in 2016 and has grown significantly over the past 4 years and now stand at more than 35%. So a premium at this level shows a considerable bifurcation in the market, and one that may continue given the ongoing phases on the decarbonization of property portfolio. So that's the first part, analyzing what's actually really going on in the transaction. But obviously, it's a difficult subject to monitor the impact of climate risk on portfolios. And if you move to the next slide, actually, to answer the question, we have actually developed a tool, which is a model, which is the climate value at risk, where the idea is to understand what's going to be the impact on real estate of the climate change. So on both components, the transition risk. So it means that how energy intensive are the building, and what significant cost can incur as part of the global effort to reduce emissions, and also the physical risk, which is what buildings can suffer from physical damage due to climate change. And actually, using this model, we estimate that approximately 12.1% of the value in the global index could be at risk due to transition of physical risk under a 2-degree scenario, which is the default model, with a transition at minus 6.8 and physical at minus 5.3%.
So that's the coloured bars on the left-hand side of the chart here.
Yeah.
So the overall being that kind of light green colour. So again, looking across the regions, it seems. Do we read this as saying that actually in the European, EMEA region was slightly less, value at risk than in the Americas and particularly in APAC?
Yeah. Currently, it's less. So obviously, you need to take into consideration the energy mix, the different physical risk. So obviously, on this physical risk part, there are a bit more in APAC. But even in Europe, in the locations are not equal. Obviously, you're more at risk if your buildings are near the coast. Netherlands, in our model, are obviously a bit more at risk. And the transition risk also takes into account the energy mix. So even in Europe, if you take France or if you take Germany, that's going to be a different story.
Great, thank you very much. Moving on, Daniel, perhaps from a Primonial REM perspective, I'd be interested to hear how we as a company approach this topic and try to implement it across the broad areas of the firm, but also the investments.
Yeah, absolutely. It has to be taken very seriously and I would say globally, meaning that it's really an issue that which is not only about asset management, it's also about what we invest in. In Corinne's slides, we saw that there's the physical risks, meaning for example, the risks of heat waves, of earthquakes and so on, and that's the harm that the environment can do to our assets. And then there's the transition risk, which is actually the carbon, energy consumption in carbon, and the harm that our assets would do to the environment. That's what we call the double materiality concept, meaning that we always have to have these two sides monitored. So we apply due diligences. We believe, first of all, that carbon is going to be the currency of this change. Basically, we have an ESG approach. Of course, we have an ESG scoring. We have ESG due diligence. But we tend to focus on decarbonization, which is the instrumental issue of climate change. And the big question is, how much of that is already in the values, is already in valuations? That's a very difficult question from a research point of view. But what's absolutely clear is that we have to reduce our investment universe, and we are already selective, and because what we buy now has to be liquid in 5 to 10 years, when these climate value at risk models will be totally democratized, I would say, among the institutional investors. So we have not only to take into account today's risk, but also the perception of these risks that will have the investors who will buy our assets. So we have to take care of the exit yield, basically, when we invest. So that's very important. We should also not only count it as a pure cost, because of course they are the capex that you pay to adapt to this new normal, but also there's the statistical term would be the elasticity, the influence of these capex on the level of rents and on the liquidity of the assets, which can be to some extent converted into performance, into what MSCI Corinne said called green premiums. Right? There's a brown discount for sure, and there's also a green premium if we manage it well. So that's what we're going to that's what we're trying to apply and prepare in the next years.
Super. Well, thank you for that. And I'm conscious that we're already coming up towards the top of the hour with about 10 minutes left. And I did want to get on to our last topic today. And so really I'd like to go around in turn with the speakers, starting with Corinne, then perhaps with Daniel and wrapping up with Jürgen, just to have a couple of minutes each to discuss what do you think are the kind of values that we as real estate investors and market participants need to show in order to not just survive, but to be able to thrive through these rather challenging times that we find ourselves in. Corinne, perhaps I could hand over to you.
Yeah. Well, I think as it has been a bit discussed previously, and particularly showed in the anticipation done by Henri Aurélien, is that you may rely more on your income return than on your capital growth on the coming year. So there should be more scrutiny on the quality of your tenants, particularly on offices, retail, and industrial. So that's a point I think for investor to look at. Obviously, on ESG, the impact of capex on portfolio, the quality of the building is also an important one. But probably from an MSCI standpoint, and maybe it's not a best value, but it's what we are going to scrutinize, is what's going to be the valuations in Q4 and how they are going to be impacted next year. That's really the biggest point, because currently still in the discussions we have with investor a little bit not completely clear.
Thank you. Daniel.
Well, I'll say two words: timing and allocation. Timing, because as Corinne showed, different sub-asset classes of real estate are repricing at different moments. So we have to be agile enough to have the good timing on every of these asset classes. One of the strengths of Primonial is that we sometimes use debt, but we are also a big equity player because we collect some capital, and therefore we can redeploy and deploy fast on different asset classes and different countries also, by the way. So it's absolutely essential to have this agility to redeploy in the new normal. And then there's the allocation side, which is to me crucial, meaning that in real estate, it's about playing the long game. Okay, so you don't just need to be right at the moment you're investing. You need to be right all the way during 8 to 10 years. So that's why it's very difficult to predict and forecast, even though we try to do it, what's going to happen in 8 to 10 years. But what we can do is not forecast, but prepare. And that means asset allocation, that means diversifying, that means knowing what asset classes will contribute in terms of income, as Karin said and Aurélien said, and in terms of capital gains. And therefore, we really want to help institutional investors to define and manage their real estate asset allocation.
Great, thank you. And I know that within your department, you've produced
Yeah.
tools and models to be able to help with that, and we did a webinar on that, which
Absolutely.
I think is also on our website a couple of months ago. So people can certainly go onto our website and find that if they want to learn more about the kind of models that we've developed. And Jürgen, finally, perhaps giving the last word to you as the CEO of a major real estate investment firm. Do you have any thoughts on the kind of values that we should be thinking about and espousing during these times in order to assure our continued success?
Sure, I do. First of all, I think in these times you have to stay calm and focused. Second, you have to motivate your people. I think people remain and are still the highest resource of a company, of a successful company. Third, it's a time where, and Daniel said it already a little bit, that if you have equity available, you can take advantage of opportunities. So we are looking for these opportunities since we have capital to deploy, which then at the end means also to have a focused strategy, because you can't do everything at time in which we are. You have to focus, and we do this by looking at specific asset classes in specific markets. Those are values. There's certainly more, but for me, those are the priorities during these times.
Super. Well, thank you very much. We are really, I think, at the end of our session today. So I'd just like to take this opportunity firstly to say a huge thank you to all our speakers, particularly to Karine, our guest speaker from MMSCI. Thank you for being with us today. And then also to Jürgen, to Daniel, to Henri Aurélien. Thank you again for joining us and sharing some of your knowledge and expertise. Just to note that this webinar will be available on our website in due course, hopefully not before too long. But in the meantime, if you have any questions or thoughts about what we've been discussing today, we are able to be contacted via our corporate email address, communication@primonialreim.com. So please don't hesitate to reach out if there's anything that we can answer or help with. So I'd like to say again, thank you to everybody, the speakers, and thank you to all of you for joining us today. This is the last webinar of the year, so wishing, I don't know if it's too early to wish everybody a Merry Christmas, but seasons, happy holidays, and we look forward to seeing you again in 2023.
Thank you, Alex.
Thank you.
Thank you, Alex.
Bye-bye.
Bye.
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 Bye-bye.